All right. You got James Zhang with Full Capital here, and you got James Wilson with Full Capital as well. Thanks for joining the live. We had some technical difficulties on the launch, the same way that I think, what was it, the Tesla launch, or the Tesla CEO Elon had a few troubles with the launch, had to push it back. We only pushed it back 15 minutes. So I appreciate everyone hanging in with us. What we're going to do today is really go through underwriting, because I spent 10 years at GE Capital doing underwriting, but it seems like everyone I talk to does it differently. So what we're going to do is sort of do a live underwrite on a deal that I actually went and saw probably about last week, so less than a week ago, and we're just going to take it from the beginning. So James, I'll hand it over to you. Let's just what is the first step? What is the first step in an underwriting? And while James is pulling that up, let us know in the comments if you're watching, sort of where you're coming in from. Are you coming in from Dallas? Are you coming in from Houston? Other places besides Texas? But we're gonna go take a look at a deal out in Fort Worth. So, what's the first step, James? While the viewers are telling us where they're at or coming in from, what's the first step here?
Yeah, first step I think is, for anyone new getting into the business, is kind of understanding what underwriting is.
Okay.
Because there was a while there where people kept saying underwriting. I didn't really know what that meant, but it really means you're analyzing the financials of a property and seeing how it's performing. So you're looking at, the income, you're looking at the expenses, you're looking at how that shapes up, and then you're looking at what the debt looks like. But the first step in the underwriting process is to get the whisper price from the broker. And somebody asked on the last stream what the whisper price was.
Yeah.
And that basically just means what the asking price that they're trying to guide, that the seller's trying to get for the property to transact.
Okay.
You won't see them on the offering memorandums. I did see one on one OM last week, but I think it was not a multifamily broker. But you usually won't see it on the listing or the OM. And so you'll have to talk to the broker, or we have a lot of the whisper prices as well. So you get that whisper price, so you kind of see, okay, this is where the property's at, this is what they're trying to sell it for, and then you can start getting into the financials, the T12, to see kind of where that NOI shapes up. So
Okay.
you can figure out the cap rate and kind of work that triangle and see if it fits.
All right. Yeah. I mean, like I was listening to a thing from Warren Buffett, and underwriting to me is basically, what is the value of the property?
Yeah.
That's simple. Like, we are going to underwrite the cash flows to figure out the value of the property. So we're going to get into all of that. Appreciate everyone jumping on. We got Lisa from North Carolina. We got DFW. We got Atlanta, Dallas, another Detroit, or two Detroits. All right, awesome.
Motor
so
City.
so we're gonna appreciate you guys jumping on. We're gonna go over to, and we got one more in Dallas. All right, awesome. All right, so we're gonna jump in. So the way I usually start is I just get the property address, and so let me just pull that up. So we'll pull it up here, and you guys can follow along. So let's see. All right, so this is the property that we're gonna take a look at. Hopefully you can see that. It's on the market right now. Call for offers is actually tomorrow. So if anyone is interested, we can make a run at this deal. But we'll underwrite it, and then you guys can make a call here. So let me pull up the map. I mean, this is usually the first thing that I will do, is just sort of pull it up and see where it sits, right? So sort of North Fort Worth, this deal. Let's see, here's a bigger map. So it's west of DFW Airport, sort of North Fort Worth. I'm up here in Frisco, James down here in Dallas. So these are really, this is probably 8 million, 9 million people total. James, what do you know about North Fort Worth? What should we know about North Fort Worth? Anything in particular? You lived in Fort Worth, right?
Yeah, I lived in kind of southeast Fort Worth, kind of near TCU. Really nice area. Fort Worth is really pockety. That spot right there is getting closer to Keller, which is a lot of single families.
Up here?
Yeah,
Okay.
a
Okay.
lot of really good school districts. Those home prices have been going up. You got South Lake and Grapevine up there, and it's
You
just north of
you see
that.
Costco up here. It's not
Yeah,
that's not that far. So you got Alliance up here, which is nice.
yeah, it's a
Um,
primary market indicator right there.
Yeah, it's a primary mark. So, one of the guys that when I first met him, he was like, "All right, I want to be 1 mile from a highway and 1 mile to a grocery store." That was sort of his uh, indicator. So let's go to the satellite and let's see. So, I mean, we're pretty close to 35 here. So that gets you sort of north south, and then 820 down here. And then let's zoom in on this guy. Um, You've got a Kroger right here. That's nice. Chase, Albertsons. So it sort of checks those two boxes, and then it has good visibility along this North Beach Street. So, I mean, in terms of that, in terms of demographics, so this is what we'll usually do is we'll usually you can go into like New York Times census map, this where in Yardi here. Let me see if I can switch it over to Yardi for you guys.
Yeah, and while you're looking up the property, one of the next steps is to download the OM offering memorandum. That has
Okay.
a lot of the info on it.
Yeah.
Download the T12. That's the trailing 12 financials. So that'll have the income and expenses for each month. And then download the rent roll, which has all the tenants and what they're paying for their lease and when it expires.
Okay. So let us know in the comments what you guys think of this location if you're here in the DFW area or maybe outside. So here's a map, sort of demographics of the area, right? So you can see sort of downtown Fort Worth. So here's the different layers, right? So green is 90 to 200,000. Light green is sort of 50 to 70. Yellow is 50 to 60. Orange and red is sort of 30 to 40. So this property, I mean, if you look at this property, I mean, it was built sort of early 2000s. So it's pretty nice property, probably class A minus property. So we're going to get into it in a little bit, but let's see. Let's go back to, all right. So here we are. So, I mean, you can see that majority, I mean, it's sitting in the yellow. So that's sort of 50 to 60,000 income. And then, but it's just right on the edge of a lot of this green. So this is probably more single family up here.
Yeah,
Um,
the further north you go there, the better the
Better it gets.
area
Yeah.
gets, and the more south you go, kind of the worse it gets.
Okay.
It's
All
kind
right.
of like right in between.
Okay. So I think you said the first thing was really download the OM. So let's pull up the OM and start there and see if we see anything on the OM in terms of anything that we should point out. Let's see. So let's start scrolling through. So, I mean, this is usually, this could be 30, 40, 50 pages. Usually we'll just pull the specifics out. So here, 216 units. Market rent's about 1,500, built in 2001, 94% occupied. So this is pretty standard 3-story garden style. 2001, your 9-foot ceilings, your individual HVAC, your sprinklered. Here's a little bit of the details here. Address, individually metered. So this is key. The roof was replaced in summer of 2021. So this is some pictures of the leasing office. Let's see
Got a
if
pretty
there's
nice
any
pool and gym.
nice pool. Yeah, so you got so they have all granite inside of the units, which is pretty nice. So you can tell this is like a little bit larger than 8-foot ceiling, 9-foot ceilings here. Here's a little aerial, backs up to a little green belt here. And then, okay, so I think anything else on the OM when you're going through the OM, James? What else are you looking at?
Yeah, you got the unit mix pulled up there.
Yeah.
I can't see. Let me try to increase my screen or look closer here.
Okay,
It
there
looks
you
like
go.
we got 61 or 108 one bedrooms, and then about the same 2 bedrooms. So it's a good 50-50 mix of 1 bedrooms and 2 bedrooms. So that's always something to look out for. For properties primarily 1 bedrooms, it might just be a little bit less on price per door.
Okay. So it's 50-50 right now. Yeah,
yeah,
ones and twos. Okay. We had a question come in. Where do you get the OM, James?
we get those. That's a good question, actually, because I think I spent the first year in multifamily not knowing where they were. So appreciate the question. You find them on the broker websites.
Okay.
So some people say like, oh, I can't find any deals on the MLS. Well, they're not going to be on the MLS, the single family listings. They're going to be on the different brokers shops websites if they're marketed. A lot of deals go transactions go off market, broker to broker, and if you're in the business, you'll get some of that info. But if you're just coming in, you're gonna have to figure out the different broker sites. So there's like the major ones. You have like Newmark. They'll have national listings that you can go on newmark.com and look at properties all over the country. You'll have CBRE, same thing. So if you want to go to Dallas, for example, you just filter out Dallas MSA, multifamily, because they'll have a bunch of other commercial properties as well.
Okay. All right. Perfect. Yeah. So you get on the list, pretty much get an email from the broker. They'll be able to tell you. And then let me see if I can pull this one up maybe. Let's see. All right. I don't have it on top of my list here. But yeah, you'll get an email sort of when all the new listings come out, and then you'll be able to take a look at it. So that's a good just sort of brief overview of the OM. So what was next on the list, James?
Look at the property address, street view, census data, Google reviews. So we just kind of did that. Just did like a brief overview of the area.
Okay, all right. Let's go back. So number one, whisper price from the broker. Do you remember what's the whisper on this guy? Let's just start there.
What is that one? Cortland North.
Cortland North Beach. So I think it's around 42 million. So what we're gonna do is I pulled up a blank spreadsheet here. So everyone sort of underwrites deals differently, and so this is sort of a basic underwriting sheet. And so we'll plug in North Beach is what this one's called, and then 42 million as a price. And so we made this little spreadsheet. This is pretty basic, but it'll give us an idea of how to figure out the value of this property, right? So so now we'll have to remember a little bit because I'm not good at switching screens too much here. So we got the whisper price from the broker. That was number one. All right, now we go download the OM, T12, and rent roll. So the OM, how many units were in the property again?
I think it said 212.
212. All right, so we've dropped in. So drop in the unit mix here. So 1 beds and then 2 beds. So it's about 50-50. 1 beds and 2 beds. And then what were the rents on the property right now?
I didn't have the OM.
Okay, here, I'll pull it up real quick.
Yeah.
I'm expecting everyone to memorize the OM. This is like this is in school, man. You've got to be quick here. All right, so here's the OM again. So we'll go to the OM. And you have to remember in the OM, it basically says, you can't, you're not, this means nothing. Please, verify everything on this sheet. So make sure you verify everything. So can you see that? Okay. So the 1 beds was how much? About $1,295, $1,365, $1,368, $1,650, and then $1,800. Okay. So we drop that in. We'll drop that into the model here, and then also figure out the pro forma. So, all right. So let's just plug some numbers for now, and then we'll sort of work our way backwards on this thing. So how much do you think we can increase rents from where they are currently? Maybe $50, $100. What's your guess here?
Yeah, we'll say $100 over 18 months.
Okay, so let's just go 100 over all
Who's the
these.
list? Who's the listing broker on that one?
This is Newmark.
Newmark.
Yeah. So we'll try to. I think right now what we'll do is just sort of plug some numbers in, and then we'll sort of work our way through the entire model, and then sort of figure out how to plug each one of these things. So download the OM, download the T12, and rent roll. So let's give people an idea of the OM, or sorry, the T12 and rent roll here. So let's go over here. All right, I'm just gonna do my entire screen, and hopefully you guys can just see it a lot better there. I'm gonna close that. All right. So here's the rent roll. Can you see that? Okay.
Yeah.
Okay. All right. So we'll go through these. So they basically have each one of these floor plans and the rent here for each one of these, so we can get a good idea of sort of where each one of these is trading. So this is how usually we'll do the in-place rent. Okay. So if you start here, and this is A1. So let's pull some of this out so you guys can see it. All right, so this is the actual rent that they're charging, right? So 1,200 to 1,400. So right there, we had about 1,295 as the in-place rent. Okay, and so we'll do that for each one of the floor plans. So 1,295 to 1,800, and then this is our pro forma rent. This is what we think we can take the property to. So we'll plug that number in, and so that's just sort of for your year one what you're going to end up going to. And then the other thing was the T12. So the T12 is really just the trailing 12 financials. And so here it is. Can you see the T12 on there?
Yeah. Can
Okay.
you go over to the push it to the right a little bit so you can see what it?
Is it
There
better?
we go. Yeah.
Okay. All right. Let me see if I can share that part a little bit easier. Okay. Here we go. All right. So the T12 is probably one of the most important items. And so I'm going to highlight a couple things and then we'll pull them into the Excel all at the same time because I think that'll be easier. All right. Let me make this bigger. Can you see that?
Yeah.
All right. So this is probably where we'll start. So I'll just do a little, I'll call it, let me save this one down and just call this like edit. Because we're going to make some notes on here on this T12. All right. So the first thing that you want to look at when you're determining sort of your net rental is really the last 3 months. So they're going to take the T3 and annualize it. So you'll take this.
Sum the last 3 months.
And then
to get a
times it by
T3,
4. All
times
right.
it-
So yeah, so your net rental on this is about 3.58. And then on your other income, you're typically taking T12. So we'll keep that number there. I'm just going to highlight these numbers because we're going to pull them into the model later. So you know where they're coming from. All right. And then let's go down to marketing. So on marketing, so pretty much everything's going to be the trailing 12 historical. On, I would say, utilities. So let's just jump down to utilities first.
Yeah. Utilities will definitely be historical T12.
Yeah, so utilities, historical T12, insurance, or sorry, taxes right here. We're gonna get into how we calculate taxes, and then insurance. This seems pretty low, but we're seeing that at probably 600 a door. And then, so this is your NOI down here. Let's see what else. So we've got management fee. That's going to be about 3%. And then payroll is going to be typically about, this is a nicer property, so probably 1,400 to 1,500. And then R&M and maintenance, that's probably closer to 800 to 900 a door. Admin also there as well. All right, so let's, I'm going to pull that to the side and see if we can pull these in. All right, so I'm going to go back to
Yeah, so I think it's
screen share.
important to note, 2001 construction, 600 a door for insurance. What does that mean for an 80s property or 70s property? Probably a lot higher, right?
Yeah, for sure. All right, so we plugged in our rents here. I'm gonna try to I tried to make this model as simple as possible. All right, so expenses down here, right?
Yeah.
Let's see, what's the first one? G&A. What are you typically seeing on G&A sort of per unit? So
So
general and administrative. This is advertising, admin, professional fees. So they've got this whole, can you see all these expenses here? So G&A can be the telephone, the office, bank charges, all that type of stuff. So that's about 120,000 here for this property on T12. Plus, let's see, the marketing. Oops.
yeah, I
And
mean,
marketing.
usually G&A and marketing is between like 300 to 350 a door.
Okay, so let's see this one. So they're spending. I'm not sure what this paid search is, and this marketing software. So it's 113,000. So 113,000. So what I'm going to do on this first run through, this is just going to be my T12. That's sort of the starting place, and then what we'll do is maybe go back through with the pro forma after
Okay.
that.
Yeah, it
All
sounds
right.
good.
All right, next is payroll. So we'll go down the payroll. So for 200 units, how many people do you typically need on the property, James?
I'd say probably 2 in, 2 out.
2 in, 2 out. So what does that
Maybe
usually run?
about 12, 1,300 a door.
Okay, so right now on the T12, they've got about 487. So it's about 2,000 a door. So that's probably a little heavy on the payroll, but let's just keep going. We'll just keep going through all these. We hit the management fee already. So 3%, I would say, is pretty standard 200 unit deal. That usually works. I would say once you get under 100 units, maybe 50 to 100 units, it might be 4%.
That's 3% of the effective gross income.
Yep. So it's going to be your total income at 3%. So if your top line right here is 3.8 million at 3%.
So your
All right.
T3 net rental annualized plus other income, and then you take 3% of that number to get your management fee.
Well, the management fee, I mean, in real life, they just take it every month. So, but yeah, once on our pro forma, that's how it's being calculated right now. This 3%. All right, utilities. So we've got electricity for sort of common area, vacant units. You got water, natural gas. So it's about 220,000 here, 219,889, and then actually, I guess we broke out water and sewer, but that's okay. We'll just leave it as utilities. And then repairs and maintenance. So let's go back up. So we got maintenance, which is going to be, all the different things, landscaping. You've got plumbing, HVAC, all that stuff, getting the units ready. So we'll combine those two. What is that? So 220,000 plus 89,000. 310. Oops. Put that down. 310,000. All right, insurance. What do we see in insurance right now? Sort of A- deal. What do we see in insurance come in at?
I guess 500 to 600 a door.
500 to 600 a door. Yeah, I mean, this is like what, 50,000 on insurance. 30 a door. Is there 230 a door out there for insurance?
I doubt it.
I doubt it.
Might want to hold on to that one.
Yeah. So, and then so taxes, I mean, we'll usually just look at real estate taxes plus franchise tax. So you're about 820,000 on this one. All right. So let's look at your revenue over here. So we're opening this up a little bit here. So your revenue was about 3.6 before other income. And then your total expenses, so you're about 62% expense ratio. So let's go through. So this was sort of the T12, right? So that's sort of your first cut. So what adjustments do you want to make So when you're underwriting a deal, you need to figure out what adjustments you can make as an investor and also what adjustments the lender is going to make. Okay. So on a pro forma basis, where do you see some ways to trim the expenses a little bit here?
I know payroll is definitely one. Could we zoom in
Okay.
a little bit on that?
Yeah.
Expenses?
So yeah, let me see here. All right. All right. So you've got. All right. So you got GNA at 1,000 a door. What were you thinking? It should
Yeah,
be closer to
250 for a property that size. Probably 250, 300 a door.
300 a door. All right. Let's maybe let's go in half. Maybe there's a reason. Let's go 500 a unit.
Okay.
So 500 a unit. Let's see, 500 a unit times 216. So you're about 108,000. So let's go with that. It's just minus. This is basically in half. Um, I'm trying to keep the original numbers in there a little bit. So, all right. So we got that. So let's go 500 door there. Payroll. What are you thinking?
I'm thinking that's really high, but usually 12 to
1,500.
1,300 a door. But let's say maybe
15.
1,500 because of
Yeah.
inflation.
Inflation. And then, I mean, so when I was walking around this property, it definitely was a nicer property. So, they're going to have maybe a little bit more amenities, a little bit more staffing, because, tenants are paying anywhere from $1,500 to $2,000 to live here, so they're expecting a high level of service. Okay, and
With the
then
guy with the leaf blower out there all
yeah, the
day.
leaf blower definitely was going. Let's see, utilities. Can we do anything on utilities, or are we gonna have
Nah,
to
so
sit?
utilities is usually just T12. You can't really, unless you could do a pro forma with maybe a bridge lender if you're going to come in and implement a water conservation
Okay,
service and you get a quote saying, like, this is what we think we can reduce it by. But typically, it's T12.
okay, and then let's go down the repairs and maintenance here. R&M, what's it usually running?
Probably 600, 650 a door, but on a newer property, maybe I could get away with a little less.
Okay. Yeah, I think it could go both ways, right? A newer property, people might just want nicer stuff on it. So I'm,
Yeah.
I'm gonna go a little higher. Just I want to keep, if I'm coming in raising rents $100, I don't want to be too cheap on my repairs. I don't want those negative Google reviews saying the maintenance is bad. All right, and then insurance. What are you seeing out there for insurance?
I'm going to say 600 a door is a
Good.
good
All
deal.
right. So let's say 130,
I,
130.
I think C class we're at 1,000 a door. You can
Yeah.
probably expect.
Okay. And then taxes, how we doing taxes here? So 820.
So we're
Um,
gonna take the purchase price, and
okay.
then we're gonna take. They're
So
taxing the building, so we're gonna take 80% to 75% of that purchase price, which will be building, and then that kind of excludes the land. So we're
I don't know if it really matters. They're just gonna. Everyone hopes that their number isn't as bad. I know. A lot of people just got tax bills. I think today or this week, and this one it might be over 42 million. Might be over the purchase price, but let's just say 85% of purchase.
yeah,
Or let's just go 80. Let's go
Sean
80.
Griffith says everything's going up. You got to be
Yeah. So
conservative. So
let's go
let's go
80%, and then
80%.
the tax rate on this guy I think is around 2.5. So you're about 840 on this one. So all right, let's pull that back down. If you go back to the OM, it has the tax rate, and you can look it up online as well in Tarrant County. And then we usually use a percentage. Tarrant County, actually, you probably should be 85. So let's go 85.
And then is 2.5% is kind of low for Tarrant County, I think. Aren't they usually
Yeah, I mean, let's
2.6, 2.7?
yeah, let me pull it up here real quick. You can see
Or
it.
is it in it could be in the
It's in the
OM.
OM. Yeah, it's in the OM. So we can just pull it up real quick. So let's see. OM. All right, so it's on the last. So yeah,
They're saying
2.59. Yeah, can you see that there? So it's a
Yep.
combination of the city of Fort Worth, Keller, Tarrant County. So 2.59% on your taxes there. So all right, let's go back
Yeah,
to
all these expenses are annualized. We're running on annual basis.
This is still the basis. So we're about 2 million. I guess we'll touch on this last one. Replacement. What's replacement reserves? What does that
How
mean?
about 250 a door?
Are you going 250? What? All right. So explain what replacement reserves are for people out there.
Replacement reserves is kind of a holdback from the lender in case they gotta do some extra maintenance or replace something. Just kind
Yeah.
of a cushion, safety buffer, if you will.
Okay. Yeah, I forgot to update the banner. This is what we're doing. We're underwriting the NOI. So T3 net rental, T12 other income, and then pro forma expenses. That's essentially what we just dropped through. And so we're about 2 million on expenses. And then let's go back. So do you remember what the other income was for the property on a T12 basis?
The other income was $478,874.
All right, so we'll plug some other income in there. Sometimes, you can maybe increase that. And so just depending on but I mean, that seems like a pretty good number for 216 units. So you've got, let's remind people of what some of the other income items are there. Let's see.
Yeah, I'll just run down the list real quick.
Oh, you got it? All right, perfect.
Yeah, so we got late fees, application fees, garage fees, pet fees, termination fees, write-offs, admin, pest control, on-site transfer, damage cleaning fee, legal fee, trash reimbursement, water reimbursement, valet trash, convenience fee, billing service, sewer reimbursements, clubhouse, cable, residential liability, telecommunications. So yeah, I think you kind of get the picture with all those extra fees you can charge the tenants. And
Okay,
all
so
that adds up to almost $500,000 a year.
yeah, so I like to just sort of underwrite the NOI that we had there, and then now let's move to number 6. So we've looked at let's just do a recap here. So we got the whisper price, 42 million. We got the OM T12 rent roll. Got all the data sort of out of that. We got it into this Excel model. We sort of looked at the property address, looked at the reviews, looked at census data. We went through the unit mix, dropped that into the model here. We underwrote the T3, T12 pro forma expenses. Now, number 6, James, determine the loan amount. So what's the loan amount on this deal? And let's just maybe plug in a number here for now, and then we'll dig into how we actually calculate it.
I'm going to go based off of current market conditions.
Yeah.
That is going to be about a 55% loan to value on an
55.
agency.
All right. So we'll plug
debt.
55. So 23 million. Interest rate, what do you think?
Let's check the 10-year real quick.
I think it was 3.5 yesterday. So, or 3.6.
Yeah, it's back down a little bit, 3.5. So we're going to add 2% to the 10-year treasury and to get 5.5%.
All right. Interest only.
Let's say it's a decent sponsor and they're going to give them 5 years interest only.
5 years amortization after that.
30-year amortization.
30 year. Okay. Closing costs.
Units.
Closing cost on a Fannie right now.
Fixed rates. We're going to say 3% of the loan amount.
Yep. All right. 3%. Working capital. How much should I sort of set aside just in case?
You're probably going to have to raise a little bit extra for the CapEx since they're not going to finance it.
That's right.
A property like that, I would probably put in, at least a couple million.
Okay. So let's go maybe 4%. So 1.7, maybe $1 million of that, or probably maybe $1.5 million is for rehab, and then 500,000 just for working capital.
Yep, that sounds good.
All right, and then All right, let's stick on this number 6. So we dropped in sort of where we think. So let's just look at this. So on our year 1 NOI, it was 2.137. Okay, and then the debt service was 1.2, and that's on an that's on an IO basis, right? So we got 5 years of interest only. So the calculation on that, I don't know if you can't see my calculator, but the calculation is basically just the loan amount, 23.1 at 5.5. That's the 1.270 right there. But is that how they calculate your loan amount, or do we need to look at something else?
No, we should probably look at our
Sizing on this guy.
handy dandy Fannie loan amortizer.
All right, so let's go over. So I'm gonna move it over to. So this is I think we can go here. All right, so we got it sized up, and so here was the sizings. So this is a Fannie Mae quote that we got on the deal. So they sized it. They got a little bit higher. They got to 2.2 on the NOI, and they were able to get. So they look at it amortizing basis. The Fannie right now, they're trying to do more business, so they're at a 35-year AM on the sizing of this deal, and they were able to get to about 27 million at 5.6, and their all-in rate, their all-in rate is 5.6 on this deal. So we were pretty close. You can look here at some of the sizing here. So they use 3% management fee. So check, we did that. Admin, advertising, they were about 575. Payroll, 1,400 a door. Utilities were T12. Repairs and maintenance, 800. Insurance, 650. And they used 803 on taxes, and then 250 for replacement reserve. So they got to about 2.2.
So we're in the ballpark.
We're in the ballpark, so pretty close. So let's flip over back to the model here and start working our way through here. All right, so we figured out the loan amount, plug that in. So
65%.
So we're coming up.
Got a little extra juice.
So let's go 60%. You want to go 60 or 65? Should we go? 65 gets us right there, 27.3. So I would always use a little bit of cushion. So the conservative underwriting.
I find people always go the wrong way. They go the most optimistic versus the most conservative, just to get stretch just a little bit more.
Yeah, so if you're wondering what Old Capital does, we actually give you that loan quote. So if you have any questions on a deal, that's what we do. So we'll help you get that loan quote. All right, so let's keep going on here. So that was number 6, determine the loan amount, interest rate. Let's plug that in. All right, now number 7, the rent and expense growth. So let's go over to this side. All right, so you have to make, so in this box, this is really just the assumptions on what we're expecting for vacancy, rent growth, other income, and expenses. So what do you think rent growth after that initial bump of $100 per unit? Should we keep it at 2%? Should we go 3%? What are you thinking?
I think 2% is a good
2% on flat. Okay.
We got some new supply coming in.
Okay. What about other income? Any juice on other income?
I mean, they had a laundry list of stuff they were charging for, so
nothing.
I don't see anything sticking out that would.
Okay. Expenses? What do you think? 2-3%? What do you think?
I think Ken McElroy had 7% this year for expense growth.
That's killer. Let's just go 3% for maybe 2 years and then back it off from there. So our NOI, hopefully you guys can see this. It starts at about 2.1 and then it goes 2.2, 2.3, 2.3, and then 2.4. Debt service, 1.4 million, increased a little bit because our loan amount went up. And then here's the cash flow for the property. And then expense ratio about 49%. Is that a good expense ratio?
Yeah. I mean, 50% is kind of the rule of thumb. It's usually, just a little bit higher, but it's better than, some pro formas have projected 30%.
30%. Yeah.
That's usually a red flag if somebody's presenting a deal and they have a 30% expense ratio. You usually can say that's probably not right.
It's probably not right, especially in Texas. If you're in another state where the taxes are a little bit different, then maybe. But the one other thing so we did rent growth, other income, expense growth. What about vacancy? What do you think on vacancy? Should we start a little bit higher at the beginning and then work our way down to 10%? So this economic vacancy is a combination of two things. One is the physical vacancy of the property, so no one in the unit, and then another piece is going to be the actual people paying you. So you're going to have delinquency and things in concessions and things like that. So what do you think? 12, 15? What should we do year one?
Yeah, we might be able to bump it up a little bit.
A little bit on the first year, especially as we're turning units.
Yeah, trying to do a business plan. Might have to pick a few people out.
And then I would say, on the vacancy, I'd probably cap it at 10%. Maybe I don't really like going below 10, just because 5% physical and then another 5% for concessions and other items there. So let's see. All right, so we did the rent and expense growth. We got that. All right, number 8, residual cap and cost of sale. So we'll move down here a little bit. What are we thinking on cap rate for this guy right now?
So what was the NOI again?
NOI current or year one?
Yeah.
So let's just use 2.056. So 2,056,000.
All right. Divided by 42 million.
42 mil. Yep.
It gives us a cap rate of 4.89%. So 4.9% cap starting.
Okay.
Residual cap, usually want to do 25, 50 basis points a year for holding it. I saw somebody, I think it was BlackRock, said that they're expecting 2 to 3 more hikes, 75 basis points. I don't know if that's true, but I looked at the Fed meetings and that pushes it out till September and then averages 9 months for the cut after that. So, I mean, if interest rates hang above 5% for another year, I think the cap rate will go a little bit higher.
Okay.
So,
let's go
6%. It's probably a good reversion cap.
Okay. Yeah. So it's usually about 10 basis points a year. 10 basis points a year. So on total, let's say it's a 5-year. So this reversion cap is what are you going to sell the property for in 5 years? And everyone's estimating. Everyone added 50 basis points. Everyone was wrong. It decompressed or compressed down all the way down to 4%, and now it's back to 5.5. So, all right, so 5.5. Let's go with that. Cost of sale. So this is what we're gonna pay the broker on the deals. So let's just go maybe 1.5% on that, and then all right. So sponsor comp. So what is this? What are we gonna plug in here?
Acquisition fee.
Yeah, so a lot of people they're gonna get a percentage of the deal, and they're gonna get an acquisition fee and asset management fee. So sponsor comp, what do you see in most people just on a straight split? No preferred return, just a straight split.
80-20.
80-20. So the sponsor's gonna get 20%. Acquisition fee, what's that usually of the purchase price?
1%.
1%. Okay. Asset management fee.
1%.
1%. So that's after your property management fee going to a third party. All right. So once you sort of drop in everything, now it's you've got to just sort of go back through this and review the returns and everything like that. So so I've purposely hidden the returns. What are you thinking for you to you've seen everything? What do you think the returns on this deal are right now? Any ideas? I'm testing you a little bit. Leverage is not bad, right?
Leverage isn't bad. So I mean, you could get a pretty good. I don't know. I just think the expenses are not growing enough to get a huge return. I'm going to say.
You mean the income?
Yeah, the income.
Income. Okay, there's not
there's a couple headwinds with income and a couple tailwinds with expenses.
Okay.
I'm going to say 80% overall return in 5 years.
80%. I would love 80%.
That's optimistic.
All right. So let's go through. All right, where the actual return is going to come from, right? So the return is going to come from cash flow, right? So you've got your NOI minus your debt service that gets to your cash flow. So 612. Let's just take year one. Can you see that? Okay, year one
Yeah.
cash flow. So 612, and then you've got your asset management fee, and you've got your sponsor cash flow. So passives are getting 449. So your cash on cash year one is 2.3, year two is 2.7, year three is 3.2, 3%. So average cash on cash is 3.0. Do you want to change your answer a little bit, or are you still good? You still good at 80%?
Cash flow is low. Go
Cash flows, all right. So cash flow is a
going
little bit
down to
light.
60. I'm going down to
Yes.
60.
So, I mean, usually you want like half your return from cash flow, half your return from the sale, right? So across the 5 years, you're getting to about 15% on your equity right there. So it's a little bit light, right? Um, so let's see. Let's go back to
A broker would say cash flow is day one.
cash flow. Yeah, cash flow is day one. But I think you've got to underwrite not only, you as a GP, you have to underwrite not only the property income, but then like you guys have to get paid too as a GP, right? So you're at about 3% here. All right. So, and then the other piece of it is, all right, that's going to come in is this reversion value, right? So if you sell the deal in year 5, you take your year 6 NOI, 2.4 million, divided by your residual cap. So 2.4 divided by 5.5, you get to your 43 million. You pay the sales cost, title company, all that type of stuff. You pay off your loan, and here are your net proceeds: the 16 million. You return your capital back to the investors to make sure they got all their money back. And then here is your net sales proceeds to the passive. So looks a little bit light because we paid 42 and you sold it for 44 million. So it's a little bit light. You think that's a little light?
Yeah, it's real light.
Real light. So so this is why it's review the return and analysis. All right, and now let's go to number 10. Figure out what you can pay on this deal. So what do you want to make? So as an LP, what would you say is a good sort of cash on cash? What's a good sort of total return for you right now?
I think 6 to 8% cash on cash is pretty good, and then I
Okay.
think you want 100 or 2 equity multiple in 5 years is a good target.
Okay. All right. So what can we change on this sheet and still be underwriting conservatively to get to that return? Are you going to change your rents? Are you going to change your expenses? Are you going to change your price? Are you going to change your cap rate? What
But
are
if
you
you
going to
put
change your
that
rent
cap rate
growth?
down to 4, I bet that juices
Oh
up.
yeah. Oh, you go straight to a 4. All right, residual cap rate 4. I sell it for 60 million, and my total return is 67%. There we go. We're done.
So that's how a lot of people made money the last 5-10 years, was buying at a high cap and selling at a low cap.
So your cash on cash didn't change, right? It was all in your residual value, right? So you bought it for 42, you sold it for 60 million. So one of the things that I usually look at on the reversion cap is the price per door, and I want to see some deals that are going to sell for 60 a door, or sorry, 270 a door, 278 a door, in that market. So I think the 4 is probably a little aggressive.
Yeah. No,
Yeah.
I think it's still good to be conservative with the cap rate. I was just kind of pointing out how a lot of people can reverse engineer their pro formas when they're pitching
Yeah.
to investors,
Sure.
Cap rate's one of those things you can lower to make it look better. Also, that expense ratio, if you drop that to 30%, that'll make it look a lot better. And then if you overestimate income on your rents, you can also increase the projected return. So in this case, I think if you got a higher debt, you could potentially get a higher return, but the interest rates are too high for I think that to really pencil out. So
Sure.
really, the only way that you can get a better return is to lower the purchase price that you can pay.
We can't.
What? Got that 42.
So I'm gonna throw it out to the guys watching. What can we do here on this deal? What do you guys want to pay for this property? We've underwritten it at a high level. Obviously, we haven't dug into every detail, but I wanted to give you at least a good snapshot of what's out there and sort of what. So, what are you thinking? What should we take? What do you want to offer on the price? Maybe 40 million. Let's go 40 million. We can maybe increase this to 65. James, can you get us a lower interest rate?
If somebody took out millions of dollars at 2% when the interest rates were that low and they have that money, but I don't think that's widely available. So I think 5.5 is about as low as you can go right now.
So this is the challenge for underwriter, or sorry, this is the challenge for general partners out there right now, right? So Sean Griffith is like, yeah, let's go to 39 million. So let's go to 39 and see how it looks out there.
We've got a couple 40 millions.
40 mil. The one's at 37. So let's see. So at 39, we're getting to 27% total return, 5% IRR. Should we just go? All right, we got one guy saying go to 37. Let's go to 37. We'll probably increase this up to 75.5. So we're still at 43.6. That's on a 5.25. Do you want to go down on cap a little bit? 5%, maybe?
Yeah, I mean, in 5 years, the cap rate will probably be a little less.
Okay, so we're at 56%. Can maybe go 72% on the LTV. All right, so what do we got now? So 60% return. Does that work?
No.
Does that work for you?
No.
Doesn't work? A 4% cash on cash?
We need interest rates to come down some.
All right, so maybe we call up Old Capital and say, hey, we need 525. Does that get it there? 60%. So this is a good box down here that we really haven't covered. A lot of people ask sources and uses down here. So can you see that sources and uses down here? Hopefully.
Yeah, can you zoom in on it a little bit?
Yeah, I'll zoom in on it. So a lot of times the lender uses a mortgage broker are going to ask you for this. So purchase price. So what do you need the money for, right? So purchase price, what you pay for the property, closing costs, your working capital and rehab on this one, your acquisition fee, so 40.3 million, and then your loan amount's going to cover a little bit, and then the equity is going to cover. So right now you have to raise 14 million on this deal, even if you bought it at 37, right? Because you got to pay not only the purchase minus the loan, but you got closing costs, working capital, acquisition fee.
And that's why the projected return is smaller. It's because you have to raise so much equity.
Like 14 million.
Put that up to 90% levered, see what the return looks like.
Well, I would not recommend 90% leverage for anybody.
Let's go 80.
Yeah, Steve had a question here on in-place cap. So we pretty much took our NOI right now is about 2 million, so 256, and then on 42 million,
was the
which was for price, it was about 4.9. So in-place cap was about 4.9. on the deal. And then Sean Griffith, he's saying 35. I would love to buy it for 35. 35 million, 216. So that'd be 162 a door. You get 25 mil in proceeds. Boom. You see that total return? 80%.
There we go. We're getting better.
We're getting better. So this is like this exercise of this last piece of going through this process of figuring out what you can pay is what every general partner goes through the deal and sort of just puts in their numbers. But then if the broker is saying 42 million and let's say you put in 35, okay? So are you good at 35? Is 35 good, or is that not good enough?
Still not that great.
It's not great. All right. So, I mean, I would say, these rents, we're bumping $100. We're not really doing anything on other income. We're not really doing anything. We're bringing down expenses in line with the market. Okay. So this is a challenge. You put in 35 and the broker says, no, it's going for 40 or 42. And then you go back to the drawing board, right? I mean, that's the challenge in today's market.
Creative finance.
The creative financing costs you a lot of money right now. So yeah. So
yeah, I think there's, in reality, there's probably a bigger price adjustment coming than sellers are willing to admit right now. But
sure.
I mean, a 5 cap on an A-class deal sounds really good compared to a couple years ago, right? Or
so yeah, so some people will definitely just buy this deal and they'll maybe put a 5-year Fannie or Freddie on it, or maybe even a floater. And then when rates come down, they're going to refi, and someone's going to buy this deal. And I would love to buy it at 35 million. I just don't think it's going to go for 35 million. Someone was asking on the rent comps. So let's dig in a little bit on the rent comps. So we've got, the rent comps here. We've got basically, you want to write these numbers down. So $1,400 for 1 beds, and then $1,600 to $1,900 on 2 beds. So usually what we'll do is we will pull a rent comp survey. So you can do this a lot of different ways, but we'll just pull it up on, we'll just run a report. We'll just run a report, but yeah, you could definitely look at the OM. We're just going to pull the report, and this is a little bit of a, so we've got $1,400 rents, right? But then these are some of your competitors in the market. So our rents were a little bit, our units were a little bit smaller. So I'd probably try to find, 600 to 700 square foot rents. And I mean, they go up to 1,500. So, this is a 2005 product that you could compare it to. These are a little bit bigger, so I probably wouldn't go up to 1,700, 1,800, but 1,500. So you maybe have a little bit of room on the 1 beds to go up. So maybe you go to 1,500 on the 1 beds, and then on the two ones, that looks pretty much capped out. And then the 2 twos, we're at 1,800. I would take out the senior living one. So, but there's a couple guys at 1,900 to 1,950. So you could crank a little bit more on the rents. So let's see if we go back to the rents, and maybe you go a little bit more on the rents. So what do you want to, maybe we go 1,450, 1,500. This one was 1,700, 1,800, 1,950. maybe. So it's a 150 increase, and now you're at 100% total return.
Boom. Made it
Boom.
work.
Made it work. Sean's saying there's going to be a fire sale in 3 to 6 months, so he wants to wait for the fire sale. But yeah, I mean, there's really not a ton of deals on the market right now, and so I mean, I think there's going to be interest in this property. I don't know if it's going to be 35. I don't know. I don't think it's going to be 35. But is it going to be 42? It's probably going to be somewhere in between, right? So I think you have to stay sort of in the market and just sort of see how it plays out. One other thing I think, so we went through the inputs. So on the left-hand side in yellow is really all the inputs, the expenses. Here's a summary. And then, so here on the right-hand side is really your cash flows for the property, your debt service. And I mean, this isn't a crazy number. I mean, on the reversion, you want to make sure that, like our deal's selling for 230 a door in DFW. Like this is 5 years from now, right? So you remember last week we went over deals in DFW. What was trading for 230 a door?
The brand new stuff was
brand
trading.
new stuff, right?
Yeah.
So in 5 years, will the new stuff be 300 a door and your stuff 230? Like, is that a sufficient gap for you to buy this deal, right?
Yeah, I think in 5 years it'll definitely be more than 240.
240, yeah. So cash on cash, average cash on cash is about 6. And then you as a sponsor, I mean, you're going to make your asset management fee, you're going to make your cash flow, and then, the sales proceeds, you're going to get 20% of the sales proceeds, and then the acquisition fee. Some people have disposition fees. So, I mean, the sponsor on this deal, I mean, this is a pretty good sized deal, $40 million deal. You have to raise, 14 million, 15 million bucks. But if you can do it, I mean, in 5 years to make 5 million bucks is pretty good. So I'm not saying one person can do it, but maybe you have a team of 2 or 3 people and you each make $1 million each on this deal if you're able to hit these returns on this deal. So the equity is about 13 million right now.
Yeah, and if interest rates get cut and then the cheap bridge money comes back in, that thing's a rocket ship back.
So now you don't sell for 50, you sell for 60. Is that what you're saying?
So for 60, maybe 70, we could push that value up real high.
Yeah. So I guess any other questions from people on the live stream? Anything maybe goes back through the list, James? Anything that we missed that you want to comment on before we wrap here? I think it was pretty good. I mean, I hope this is what we do sort of day to day on a deal. I mean, we really we can go. Maybe I'll run through the steps one more time just as a wrap up, and then maybe give us some final comments here, and then I think we hit everything. I'm just going through the list here.
Yeah, somebody asked if they could rewatch the video, and we'll keep this on both of our YouTube channels, so you can watch it at any time.
All right, so let's just run through the steps one more time. So get the whisper price from the listing broker. So like on this deal, it's 42 million, right? So start there, and then as you can see, this is an exercise, right? So you're gonna start there, go use that as the starting place and work your way through. Download the OMT12 and rent roll. So this is really going to come from the brokers. So if you're looking, I would say in any Texas market, we pretty much have the list of all the brokers. So if you need broker names for DFW, Houston, Austin, San Antonio, whatever, any of that, we can get that for you. And then number 3 is just put it in Google, right? So look at the street view, census data, Google reviews. We didn't cover the FEMA map, but if you just search, I'll just show this real quick because I think it's important.
See if you're in a floodplain.
Yeah, definitely check if you're in a floodplain. Definitely check. So let's pull this up real quick. All right, so FEMA flood search by address. So you can just pop in the address. So this is 7,000 North Beach, I believe. Yeah, 7,000 North Beach. Let's plug that in. All right, that's going to take a second to run. And then, so what you want to look at is make sure. So if you do not have, you do not need flood insurance if you're over here on the left-hand side, right? So on the left-hand side, this is X. If you're in any colored section, then that's going to require you to get flood insurance, right? So if we zoom in here, we saw some of the pictures before. So if any of your buildings are in zone AE, you have to get flood insurance. And so that can be, if it's for one building, it's usually not that much more expensive, but it's for a lot of buildings, it could be very expensive. So a lot of stuff down in Houston is a little bit more expensive. So you just have to work with an insurance broker, and then they're able to give that data for you. So, all right. So the other thing that we looked at was we didn't talk about is Google reviews. So I mean, actually, if you pull up the Google reviews, I usually just sort by newest and just sort of see what people have been saying. I mean, the reviews on this place are amazing. I mean, it feels like this is a resort. I do not see one negative review on here. I mean, this is just, oh, here you go. We got one, but there's no comments, right? So I mean, I don't know how much to place into that, but I mean, Google reviews, I think, whether lenders look at them or not, whether Fannie or Freddie look at them or not, I would say if there's a common theme, like I don't have hot water, there's a lot of crime, like that type of stuff, then yeah, I would be a little bit hesitant. But I mean, that's pretty good on the Google review side.
Yeah, with that payroll, you should get a pretty good
Good
review.
mix, right? Yeah. All right. So that was address. And then let's go to number 4, unit mix. So making sure that you understand the rents, square footage, pro forma rent. And then you've got to underwrite. This is probably the longest thing, right? Underwriting the NOI, figuring out where you are in place versus, your pro forma and all that. And then let's see. And then number 6. So once you underwrite the NOI, then I would look at a deal and sort of reach out to us. You can underwrite it. I'd probably plug 60%, 5.5% interest rate right now. And then if it works at that number, and then, determine the loan amount, interest rate, that type of stuff from the term sheet. And then now you got to get into projecting your rent and expense growth, number 7, and then your residual cap, cost of sale, review the returns, and then run sensitivity. I think we didn't really go through this, but you saw the sensitivity around residual cap rate, right? And I would say another sensitivity. So a lot of times, and I'm not going to say everyone does this, but let's just go back through, if I can find it. Hopefully I didn't close it. All right, I got to open it back up. But talk about what are some sensitivities that you've seen general partners run on deals?
Like sensitivity analysis, or
yeah, sensitivity analysis.
just on cap rates.
Okay, cap rates.
You can get a range of cap rates. If the cap rates jump up to 6-7%, the return will be a lot lower. If it goes down to 4-3%, the returns will be a lot higher. So that sensitivity analysis. Usually I don't do that wide of a range, but maybe like quarter, half basis point, or quarter, 50 basis points. Somewhere up or down a couple notches to see where the price shakes out.
Right. So I mean, if you look at this deal, all right, so we're using 5% reversion cap right now. The total return is 96.5, which is basically 2 extra money, right? And then if you go to, let's say 5.5, it goes to 68%. So that's dropped your return by 30%. And then let's go to 6. Now it's 45, right? So there's a lot of sensitivity around, I would say, cap rate. So let's go back to the original 5%, 96.5% total return. And then just this one change on rent growth. What are you seeing on rent growth for some of these deals? Like 3%, 4%, 5%?
Yeah, I mean 3% was kind of the standard underwriting, but yeah. I think the last couple of years they're seeing double digit 20%. Like that's not really normal.
Yeah.
So 3% is probably good.
So let's go 3%. So it went from, look at that. So it went from 96.5 to 123 just with 3%. And you could probably justify 3%, right?
Yeah.
So, I mean, run some sensitivity analysis, review the returns on the deal, and then let's see this last one. Figure out what you can pay now.
So now that we got a little bit higher rent growth, we can pay a little bit more.
Yeah, I mean, if you go back to this, all right. So let's say you crank the rent growth, and now you just need to double up, right? So you go 37. You're still at 100% total return,
It's
right?
38. We get to 38.
At 38, you're still going, right? So you're still 90% return. I'm still doing the deal. 39, and you're at 80%. And most people will still take 80, right?
Yeah.
80 over 5, that's still 16% IRR.
Yeah, I think a Class
Right.
A will trade at a 5 cap right now.
5 cap. Okay. Yeah. I mean, that's what the end place is right now, right?
Yeah.
So, I mean, that's why I think this deal might settle even at a 40.
Yeah.
Right? You have a 12.5% IRR, and you're at 40 million if you do the rent growth. So, there's a lot of sensitivities out there, and you just have to figure out where you want to push on some of these deals. So, let's see. I think that was the last thing. We'll put. I think if you want this Excel, we can send it out to you. Just if you want to review it or anything like that, and just go through it. Just sort of, I always like just going through formulas myself. I think I'm pretty analytical like that. So we'll ask that you like and share this video with everybody, and subscribe and comment, do all the stuff that you're supposed to do. Any questions out there before we jump off of the stream?
Yeah, I appreciate everybody's comments and feedback during the live stream. It definitely makes it fun and interactive. So we'll keep putting out information like this as long as people keep watching and participating.
Yeah, we appreciate it. And yeah, just like, comment, share, and we'll be back next week. James and I are going to do this pretty hard, I think, for the next month. And then in the summer, we'll have to see how it goes. But yeah, I mean, appreciate it. And if you guys have any questions, definitely reach out to us, and we will talk to you next week.
All right. See you guys.
All right. See you guys. All right. Bye.